Good afternoon, everyone, and welcome to our webinar. Thank you very much for joining us. My name is Henry Munzaro, and I'll be your host and taking you through the agenda on screen. I think for those who attended the In Perspective Roadshow, the clear message we left you with is that we're bullish or positive on fixed income this year. So for today, we've got Sylvester, who's our Deputy Head of Fixed Income and a Portfolio Manager, and he'll be taking us through which fund to invest in, which is the Flexible Income Fund. So he'll be making the case for why to invest in this fund. After that, we'll have a Q&A, and then we'll sort of wrap up. So the idea is to keep you here for about an hour. So let's get straight into it. So Sly, over to you.
So as Henry said, I mean, we just came off the roadshow, and the focus there was mainly on markets and macro views. And the idea for this webinar is to not delve deeper into that, as our views are largely unchanged. So my idea would be to focus mainly on the Flexible Income Fund, go deeper into it to leave you with a good understanding of what the proposition is about and what to expect for the coming year. So, I mean, but to obviously set the scene, I'll start with a quick take on what's impacting the market at the moment. Obviously, we started the year with a big rally in the market, with virtually every asset class posting big positive returns on the back of the market pricing in the expectation that interest rates will peak soon, mainly in the US, on the back of slowing economy and inflation having peaked. We also then, saw most of the curves, especially US curves, pricing in or discounting interest rate cuts. The latter part of this year in the US, there was about 60 basis points expected, and South Africa saw 25 basis points of cut expected, which was a good environment. But February started off on an opposite footing, actually, largely with most of the data coming out of the US showing that the economy is still strong. We had the unemployment data that was good. Inflation prints was not slowing as much as the market has expected, which led to, or created a lot of volatility in the short rate space, with the market now pricing out those cuts that were expected. And where we are now, our take is, yes, there's jitters around interest rates globally, or rather in the US, having to stay higher for longer. But what we strongly feel is the market is not yet adequately pricing in the recessions that's still to come. And we strongly feel, over the coming months, the US economy will slow down and take most of the economies down with it. Mainly being, the main reason being, we strongly feel we are yet to see the full impact of the cumulative rate hikes on the real economy. So as that, or as the data unfolds over the coming months, that, that economy is slowing down, even if we don't see interest rate cuts in the latter part of this year, we strongly feel bond markets will quickly move to price in those cuts, which will lead to collapse in bond yields and create a very favorable environment for markets. And which is why the messaging throughout the roadshows was this year will be a year for bonds. And I mean, if you look at, yes, February came with a lot of risk off and some of the rate cuts being priced out. But if you look at how the bond market behaved, other than the few countries on the left with domestic issues over this period, most bond yields were actually sideways. So if you look, I highlighted US and South Africa. US basically showing that the 10-year bond yields being only about 10 bips or lower higher versus where we started the year, and South Africa actually being slightly negative. And also, if you look at the entire emerging market spectrum, usually, in a risk-off environment, bond yields or emerging market bond spreads tend to widen, as can be seen around the middle of last year when inflation fears started. But when you look at towards the end of that chart, the reaction this year has been muted. And the main reason for us being, what I'm showing on screen now around the expectations for growth. You can see the IMF expect South Africa to slow down by 1% versus 2022 growth numbers. But most of the major economies are expected to slow down now. And we strongly feel, over the coming months, data will start coming in to support that fact. And given that bonds tend to do better than other asset classes in a recessionary environment because of the expected rate cuts, we strongly feel bonds will do better than most, and even cash in this environment, largely because the running yields are high. Looking at what has since happened locally since we ended our road shows, focusing mainly on the budget and the grey listing. To start with grey listing. So what is grey listing? Simply, and in a South African context, grey listing means we simply do not meet a set of standards that the FATF has set, especially in the area of fighting terrorism financing and also money laundering. And as a result, we've been placed on this increased scrutiny list, which is the grey list. And we've been given 8 issues or 8 tasks that we need to address between now and the beginning of 2025, when we'll be assessed again to see if we should be taken on this list. Henry, you like asking the so what question. So what for us is, and that's a view that we've held for quite some time, that from a market point of view, we do not expect this to impact, or we didn't expect this to have any impact. And this could be seen or evidence when the announcement was made on Friday. The bond markets didn't react much. Most of the reaction was in the currency, but also briefly. And we expect it to be like that going forward. So we are by no means saying this is a non-event. For cross-border transactions, especially for banks, there will be increased scrutiny, meaning there will be more administrative burden on those entities. But from a market's point of view, we think that's that. So our expectation is, South Africa has asked the FATF to assess us again in June this year, but we think that's too soon. We expect this to take about 12 to 18 months before all those issues are resolved, and then we can get off the grey listing again. So turning over to the budget, the Eskom budget, as I would like to call it, main message is this was a credible, it was a good budget, a credible budget. And if you remember in October, the finance minister hinted, or rather messaged, that they're looking to give Eskom between 130 billion to 250 billion rands to take over their debt. And we were happy that they actually came on the top end of that range, simply because of the issues the country is facing on the electricity front. And as you know, this affects everything, and structurally, will if not addressed, will lead to lower growth for quite some time. So we're happy that Eskom now has some breathing room, and hopefully over the next few months they can take some of this money that they were using to finance their debt to actually sort out the electricity issues and unlock the economic potential in the economy. And obviously the graph you're looking at is the debt to GDP profile. In October, we're showing that dotted gray line, showing that debt will peak at 71% before consolidating lower. But because of this 252 to 54 billion that's been given to Eskom mainly, that profile is a bit different. So debt is now expected to only peak around 74%. But to us, this is neither here nor there. This is actually the original, or it looks like the original debt profile that we showed, or the government showed in February of last year. Not to say it doesn't mean anything, but we take comfort in the fact that they are still adhering to fiscal discipline, especially on the expenditure side. They are being restrained, which is why we think, other than the good revenues that we saw in the current fiscal year that's about to end soon, they showed a positive primary budget balance. And as you know, primary budget surplus is what you need consistently to address your debt burden. And they actually penciled in, or they budgeted that they will keep the positive balance over the medium term. We think it's a bit ambitious, but it is after all, it's still a budget. At least it shows their willingness to, I guess, to toe the fiscal discipline line that they set themselves some time ago. Where do we see the risks in this budget? Mainly on the expenditure side, and it's two items. The first one being on the wage bill. We don't think they adequately budgeted for the wage bill over the medium term. So over the next 3 fiscal years, there are risks that even this year's wage negotiations settle higher, which will add, we think, this year about 20 to 25 billion rands to the wage bill. And also, I guess, you're going into an election year next year. For some time, they have kicked down the, this can around social grants, the social relief of distress grants down the line. And we think over the next 2 budgets, so either the medium-term budget policy statement in October this year or the February budget next year, they will need to make some resolutions on it. And obviously, we think it will probably settle higher than the 350 that they're currently sitting on, given the pressures in the economy, which will add on to the expenditure pressures. But other than that, Henry, we feel it was a strong budget. It was well received by the market. I mean, even in this risk-off environment that I'm painting, we saw the bond curve flattening hard, especially post the budget. I mean, the yield curve is down, has flattened by between 20 to 30 basis points in a month in a global risk-off environment, which is good. It shows that the market actually took to this budget in good strides. And to end off on, on this section, what I'm showing there is the returns across the different strategies in fixed income. So obviously the environment where you expect inflation is an issue of the past. Interest rates are about to peak by the second quarter of this year. We think interest rates would have peaked in the US, South Africa, and there is a chance of interest rate cuts coming through. Fixed income presents a good spot or a sweet spot, we think, in this environment where, I mean, if you expect, our expectation is inflation will average around 5.5%. And if you can get the kind of returns you're getting in fixed income across the curve, I mean, it's a compelling proposition. And why I'm highlighting the flexible income strategies is that, the good thing about this strategy is it gives us as a manager the ability to straddle between those other strategies and other asset classes. So for instance, if increasingly during the year data comes out and which pushes us to be negative on the market, we can take these portfolios and make them look like a money market portfolio to be defensive. And again, on the opposite, if we are bullish, we can construct them to look like a bond portfolio. So it takes the pressure off the client to make those decisions of calling when it's a good time to allocate to one asset class versus the other, because as the portfolio manager, we are closer to the markets and we can make those decisions swiftly for clients. And we think in the environment that we're in now, given all the volatility and uncertainty in the markets, this is a good strategy to be in. Now, proceeding to the fund itself. So we had, maybe before the portfolio, let me start on what we think sets us apart from our peers or our main peers. On the slide that you're looking at, we showed, when Henry introduced, we showed the slide of the team. It's a very diverse team. And this is not a selling point or for regulations purposes. We strongly believe this is a strength for us, especially for strategies like now, because the way we make asset allocation portfolios in this fund is, on a monthly basis, we sit around the table, we debate prospects across all the other asset classes that we can invest in, and then come up with an investment view, whether we overweight certain assets, underweight certain assets, and so forth. So we strongly believe the more diverse the views around the table, the better the outcome for clients. And we've demonstrated that over the past 3 years since we've actually instituted the new SAA for this portfolio. So we think that's a great strength. And also added to that is, not only are we the largest in terms of assets under management, but we are seen as one of the most stable teams in SA. So, which means there's consistency in our approach, there's adherence to our investment process, and then the other factor that I would like to highlight is how active we are as dynamic managers. Yes, Henry, you might say everyone is active, but my counter would be, but we are active. And by that I mean we're proud of our approach in a sense that we're more active than most of our peers in pulling many levers, and you will see this coming up more and more as I delve deeper into the portfolio in the coming slides. And we think in an environment that is in an uncertain environment, you need to be nimble. You need to be able to change your view, not be married to any view. Admit when you're wrong and change, and to the benefit of the client, and try to pull as many different return levers as possible. And we'll show that in this portfolio. That's what we've done over the last 3 years in a very tough market environment. So, looking at now the positioning of the portfolio. So, this fund is a multi-asset income fund, which invests in all income generating asset classes that are on the left of your screen. And we make asset allocation decisions, as I said, in TAA meetings, guided by the SAA guidelines in the column in the middle, the SAA column there. And our aim basically is to give you returns in excess of 1 to 2% above what traditional income funds would return, which means we then have to take some capital risk, or there is an element of capital risk in this portfolio. Two things that I want to highlight with regards to current positioning, and this is the most recent positioning, by the way. So I spoke about our expectations that economies will slow down and probably go into recessions this year, which means bonds will do better than other risk assets. That's why most of the active positioning, so we're about 15% overweight bonds. But also more importantly, on the last column, the 6 months change, what we're trying to highlight there is how active and bold we can be in our asset allocation decisions. So if you look, so that 6 months change talks to where we are now versus where we were at the end of August. End of August, I mean, there was still a lot of worries around inflation. We're still worried about inflation, a lot of uncertainties around rates trajectory, and locally, the political environment was just getting a bit uncertain, and yet bond yields had rallied so hard that most of those risks are not reflected in the portfolio, which is why at that point our allocation to fixed bonds was as low as 16%. We were hiding mainly in cash and floating rate notes, but we also had big allocation, sizable allocation to inflation-linked bonds to protect against inflation, and we had taken some money offshore sitting in dollars, in US dollars. And the reason it was sitting in US dollars, we felt still that given the uncertainty around terminal rates of the US curve, we expected that probably the US 10-year will peak a lot higher, which is why we stayed in the currency until the US 10-year was around the 420 level, and then switched that entire allocation into bonds. I mean, talking about offshore bonds, this is one aspect. If you look at this slide, where you can say we got it wrong, and reason being, if we expect economies to slow down, and generally in recessionary times, in recessionary times, core bonds yields tend to collapse, but emerging market currencies sell off. So if you have, ideally, we should be overweight that space because that will actually shield the downside when data starts coming through to support that view. So that's one area where we're looking for better entry points. It doesn't help that we now, I mean, at 18.5 or 18.20 this morning for the currency. But when we see good entry levels, we'll correct that positioning. Now, this very busy slide that you're looking at here, I mean, I would like to draw your attention to the left, where we're showing the dotted lines. It's very hot here.
It is.
Yeah. So
I thought it was being put under the spot.
Yeah, I thought so, but I just keep on sweating. Apologies. So on the left, the dotted lines, that shows or rather that's at the end of December 2019. So What happened there is we changed our SAA. So prior to that, this portfolio was amalgamated with our aggressive income fund then, and had a benchmark of, a third in bonds, a third in cash, and a third in property. And obviously, if you have a benchmark or benchmark to asset classes, you can't have zero exposure to that asset classes because you're running high tracking errors there. So when 2018 happened, or the property woes happened in 2018, we had a sizable allocation in property because of the benchmark that was driving us then. And, this fund suffered major drawdowns. And we had to go back to the drawing board and say, is this the way we should be managing a portfolio like this with the risk profile that it has? And, we did some work at the beginning or end of 2019. We adopted a new SAA, which is very flexible in our view, in a sense that the new benchmark now is cash. And the benchmark being cash, it forces a certain risk approach in when managing this portfolio, meaning we can't afford to say, okay, bonds returned -2%, we returned -1%, so we've done well. So risk for us in this case is the absolute loss of cash. So our approach is to, at all times, protect the downside. We want some upside participation better than traditional income funds, but our risk framework focuses a lot on protecting the downside, and you will see it in the slides that are coming through. So when beginning of COVID happened in 2020, we had a new flexible benchmark, and as you can see, around February, the navy blue, the top part of the graph shows was close to zero, meaning we had close to zero allocation in bonds. We're mainly sitting in cash and floating rate notes, which we couldn't do before, and which shielded the portfolio a lot as the market was selling off. And later on in the year, you can see that the dark blue, or rather the navy blue portion of the portfolio is increasing because bonds had sold off to levels that we thought were unreasonable, and we decided to allocate more. But another takeaway, I guess, from this slide is you can see after the dotted lines, a lot more colors are coming through, meaning the portfolio is a lot more diversified, and not only and they're not static, which talks to how active we've been managing our asset allocation over time. So it changes depending on different market environments. So the circle shows basically in end of August last year, when we had 16% in bonds, sitting mainly in cash and floating rate notes, until the market sold off and we increased our allocation to that space. Now, so risk management or management of the portfolio doesn't just happen or end at diversifying the portfolio. We dig deeper, and this is, I guess, what sets us apart from our peers, in a sense that unlike our peers, our modified duration we also pull that modified duration lever quite hard, as a big source of return. And so on the chart you're looking at, that's the blue bars. So beginning of 2020, the modified duration is as low as a money market or a cash plus fund, even though we could hike it as high as 4 years, right? So when COVID happens, bond sell off, we moved duration to, and the bond selling off is the black line that you're looking at there. We're using the R186 to represent the short end of the bond curve that we mainly focus on in this portfolio. So the bond sell off came, and then we increased duration to above 2 years. But as I said, we are not married to a position. We realized soon after that we were wrong in hiking the duration so soon. This COVID crisis might be bigger than we expected, and we took that risk off again, and then waited until we had better clarity of this situation. And as you can see, for most of 2020, we ran durations over 3 years or close to 4 years, and waited until yields. R186 yields in 2021 went as low as below 7%, and which paid very well for the portfolio until a point last year when inflation was a problem. We were mostly defensive for most of the year, and you can see now the R186 yield moving up, meaning the market was selling off. We had very defensive duration positioning until only the end of Feb, until yesterday, essentially, where now we feel where the bond levels are, there is value, and we've hiked duration back above 2.5 years. So, which for us says you can take obviously some of our active peers that will just maybe run a duration of 2 years, but when bond yields in an uncertain or volatile environment, when bond yields sell off and rally, you're losing up on some of the returns that you can harvest for your clients. So we choose to rather stay close to the market and vary that positioning according to our views or prevailing views, and not to take ourselves too seriously. When we're wrong, take it off, and I guess adhere to your risk framework, to your investment process, to make sure that over time you add value for your clients. And that can be seen on this next slide here. I mean, this slide, the left or the light blue dots are the returns, 36 months returns of the flexible income fund compared to an all bond index. So the first thing to look at or to realize on this chart is the average return over the 3 years for the flexible income fund is actually 20 basis points better than the all bond index. That's the first point. But the second point is how clustered our returns have been. So if you look at the all bond index, which are the black dots, for instance, the lowest return over the 3 years has been 2%, which is the lowest dot there, and the highest has been around 11.5%. But you can see how dispersed they've been, meaning, and that's largely driven by the volatility in that fund. I mean, the bottom axis talks to the volatility or the risk of the portfolio, so which sits at anything between 6 and 10%. Average volatility being around 7%. Whereas, talking to the downside protection in this portfolio, over the same period for flexible income fund, the lowest return was just north of 6%. And yes, the highest return is not 12%, but because of the approach, you obviously have to give up some of the upside, and that's we're not trying to match the old. We merely trying to give you around 2% above your traditional income funds, which shows that our adherence to our investment process in very tough markets paid off, and how active we've been in moving our asset allocation around, our duration positioning around, and actually pulling most of or eking out returns from different levers as much as possible worked out well. And just now zooming in on the performance itself, this slide just shows consistency across the board from the headline returns. So 1, 3, 5-year returns north of 8%. And this is, don't forget, in an environment where in the 3-year space, interest rates at some point were about 3.5% lower, yet the portfolio still continued to deliver versus the benchmark, rolling a 3-year outperformance of 3%. That's quite decent, especially given the risk or volatility of around 2%. So this portfolio, or rather the new process, we are comfortable is working, and we will continue to deliver in going forward in very uncertain markets. And to just show where the point I was making around what makes us different, us being able to pull all return levers. I mean, if you look at 2020, you can see clearly that credit and bonds did most of the heavy lifting, and only property, I guess, detracted from performance. But you look at then if we move to 2021, most of the heavy lifting was done by preference shares and property. And then come 2022, cash was doing most of the lifting along with bonds. So, depending our dynamism in how we manage the portfolio helps us, because depending on the prevailing market conditions, we're able to tilt or asset allocate in different, asset classes that we think will give returns. And this is the value add, I guess, that we put forward to our clients, that leave that asset allocation decision to us, and we'll make sure we maximize your returns over time. And compared to our peers, this is on a 3-year view. You can see, which is the blue line at the top, that this over the measurement periods, this portfolio has consistently been in the top quartile rankings against our peers. So in closing, or in short, as I said during our road shows, that the party this year definitely is in bonds. But I would like to add to that, certainly from my view, the better music and better alcohol is in this strategy this year. Thanks, Henry.
Okay.
Back to you.
Yeah. Okay, Sly, thank you very much for that comprehensive overview, and good to see the the conviction remains. I guess while you have a chance to have a glass of water, just been sort of going through, and there's some great questions that have come through.
Okay.
But certainly, I think the key takeaways I'm hearing from you are that first, it's about the flexibility of the mandate that you prize, especially in the environment we're in, versus our peers. You're certainly prepared to pull those levers and be far more active.
Yeah.
And I guess in terms of since the refinements to the mandate, the track record is there to show that you're doing that well. So I guess I'll start with a question will be familiar to you because it's a question we often have in our own investment meetings, which is the "what if you're wrong" question, right? So I think it's Sean who's got it on the chat, and the way he poses it is, if bonds are offering such a great risk-adjusted return, why have foreigners over a period of time consistently been sellers of our market? So in other words, I think what he's really asking is, what are they seeing that we're not? And I guess for you, it's also, I guess, a great opportunity to talk about the interactions you have with our global partners around this same question. So well, let's maybe start off with that.
It's a good question, Sean. And the last 3 years has been tough for South Africa in particular. So from being, downgraded to junk, and then soon after that, having to deal with, once in a lifetime kind of crisis in COVID, and which decimated fiscal, balances or the government finances and SOE finances. So the risks flared up, but not only for us, for most of emerging markets, of our emerging market peers. And in such an environment, obviously, risk of environment calls for a defensive positioning, and EM, unfortunately, is mostly one of the first asset class to be sold, and we were not spared. And remember as well, South Africa, given how liquid and deep our market is, both on the currency and on the bond side, we are sometimes used as a proxy because foreigners can come in and out, without much valuation impact. And when in risk of environment, because we're a proxy, will be sold first. Not to say we didn't have our own goals in this environment, but the environment called for a bit of defensive positioning, which I guess you can flip it as, yes, at some point foreigners were 42% holders of South African bonds. That's now down to about 28%. It means positioning is cleaner, right? When the risk dial turns a bit positive, now that we are now back on track in terms of improving our fiscal or our government finances, and also we are addressing some of the structural issues in the economy. Those gains will lead to more, foreign money coming back into the country. I mean, I took comfort in the fact that in Jan, actually not Feb, we don't have the February stats yet. In January, we saw about 30 billion or 39 billion of bond inflows from foreigners. We still stick out. I mean, from a valuation point of view, other than Brazil at the moment, from a real return point of view, we still stick out as showing value. And it's just a matter of the risk environment improving before we start seeing those flows coming back in again.
Okay, I think you've answered that quite technically, so we'll try again. Okay. I think maybe if I put it this way, I think where maybe Sean and myself are getting to is, obviously, we like that you've got conviction in your view.
Yeah.
But clearly, and you've also highlighted in sort of your process, there's that willingness to accept either risks that are not being totally catered for, or if you're wrong. So I guess maybe if I ask it this way is, what are the risks to your positive bias? I mean, you've spoken about that. Underpinning it is slowing economies, which is generally good for bonds. You've spoken about the starting valuation being attractive.
Yeah.
What are the risks? Is it, maybe let's try and sort of pin it down to 2 or 3 risks to your view.
So the main risks are actually globally and mainly out of the US. So the main risk to this view is if data continues to come through showing that the US economy is still vibrant, still strong, the employment data still holds up very well, that means there can be another leg up in inflation globally, right? Meaning, yes, interest rate hikes could end, or rates could peak and stay high for some time. And because there's a second leg to inflation, interest rates will need to move higher. And that environment will be, given that, I mean, if you look at money market curves across the world, most of them are flat. They've priced out the cuts that they had earlier in Jan, but they're not pricing in another 100, 200 basis points of interest rate hikes. So if incoming data points to that direction, then,
okay.
That's the big risk to this portfolio. But again, I'll highlight our process. We stay very close to the markets. We admit when we're wrong, and we change. Okay. And the good thing about this portfolio in particular is because we don't generally invest in underlying, say, credit securities that are very illiquid to get out of. We're nimble. We can turn the positioning around within a day. Okay. Entirely. All right. So we'll react accordingly if that situation pans out.
So you're effectively saying that the rest of your view is the US economy and global economies continue to perform very strongly.
Yeah.
That would be the risk. Okay. Thank you. There are a couple of questions that, if I lump them together, really, the way I see it, are process questions. And they're trying to, I think people have taken away that you're tactically prepared to be more active than either some of your peers, or it's our DNA and part of your process.
Yeah.
But I think the question is really trying to understand, how do you marry that with still having some sort of longer term strategic view? So I think they're really trying to understand how those two come together. Okay. A longer term strategic view, but within there, prepared to be tactical, prepared to be nimble if need be. So maybe how do you, in terms of your process, deal with that?
Okay. So, I mean, I simplified our approach in, maybe ending at how we diversify the portfolios, how we actively move around the portfolio. But there's a lot more involved in the background and in how we manage the portfolio. So maybe to answer your question directly, that talks to our investment philosophy, which is, we believe over time markets will revert to their fundamental values. So when we take long-term or positions, when we make long-term investments, we make them based on those structural views. And there are many structural views. Being one, I mean, we've been saying the bond portfolio is quite negative on credit for quite some time. We downweighted that allocation from, say, 2015, 2016, about 40% of the portfolios, to now just over 10% of the portfolios, because we think from a risk return point of view, it's not, credit is expensive. So structurally, we've held that negative view for quite some time. But the second part of our philosophy is we are cognizant that, there can be noise in the short term, which then moves your valuation from where they should be fundamentally, and we prepared to deal with that, or rather look for those mispricing in the short term to create additional value for additional alpha for our clients. Why I'm bringing that is, if you look at the last 3 years, and I get why those questions that you're lumping together are coming through. Last 3 years, fundamentals were generally out the window. There was a lot of volatility. There was a lot of uncertainty. There still is. And the market environment then, dictated that you could choose to take a long-term view like some of our peers do and say, in 5 years, this will pay off because the noise will be out. Or you can actually pull the second part of our investment philosophy, which is to get dirty with the market, to try to constantly look for those mispricing and take advantage of them on behalf of our clients. It's not coming through yet, but that's result. Or the structural long-term strategic views are not coming through strongly in this portfolio, but that's as a result of the market that we're in.
Okay. I guess it's quite a strong point in that if we just look at markets overall, because of the liquidity injections and what have you, there have certainly been lots of periods where you could say fundamentals were not driving the market. Yeah. So I guess an ability to have a fundamental underpin, but still recognize where the market is at, is ultimately what you're trying to do.
100%, yeah.
Okay. Then another question, and again, I link it to being a process question, is, and you sort of answered it when you're talking about ultimately this fund is trying to deliver on two, you could say, objectives. One is capital preservation, but also a competitive return.
Yeah.
So it's looking at the risk side of that discussion and saying, in terms of risk in the portfolio, what metrics are you talking about, and what does risk mean to you effectively?
Okay.
I mean, we've spoken explicitly about drawdown, but is that the only metric that you use?
So overarching approach to risk is loss of cash. I mean, risk for us in this portfolio is not relative. Unlike in, say, your bond portfolios where you're trying to manage it against a benchmark, risk for us in this portfolio is the loss of cash. So our approach in how we construct the portfolio talks to always protecting the downside. But we look at many factors, so not only volatility. For instance, after the asset allocation meetings, where Victor and myself come in as the PMs. So we have made our over and underweights calls in those asset allocations, but we then need to do what if analysis on the portfolio. So we look at to say, okay, say maybe the resulting volatility in the portfolio is 3 years, but let's shock this portfolio and say, what if another COVID scenario were to happen? How will it behave? Right. Yeah. Let's look at the recent correlations of these asset classes into what they behave. So if you overweight fixed bonds, you overweight nominal bonds, and overweight, say, offshore bonds or property, have you doubled up on risk? How will it behave if, a certain event was to happen? So there's so many ways that you look at the risk, and if and I guess this is what's different compared to how we were managing it previously, where decisions were just made at the asset allocation meeting and that's that. But if, when we look at all these risk factors, or even we were happy we instituted what was the outcome of the asset allocation meeting, but something moves, we're not happy with the risk that we're seeing in the portfolio, as portfolio managers, we are allowed to make the decision to change it around, to vary those allocations so that, it's within our risk budgeting or our risk appetite.
Okay. So in other words, it's a more holistic approach that considers or interrogates conviction, it interrogates probability of loss, it interrogates correlation of asset classes. So it's
100%. Okay. And we have markers, right? I mean, so I spoke about how actively we pull that duration lever quite hard. And it's not us sitting there and saying, thumbs-up, okay, market is run 20 points, no, we in our strategies, when we strategize, we'll have markers in place to say, if we see a rally in, so our fair value is X, say now a 10-year fair value is 9.5%, the market is at 10.5%, we expect this fair value to pan out over the next year. But we can see a situation where within 2-3 days, market rallies by 50 basis points, on the back of whatever the outcome was or the factors were. We can look and say, sure, we expected this view to pan out in a year's time. Going forward, do you think markets will hold at these levels, or were these just the technical factors that were driving the markets and will dissipate over time? And then we can decide to take money off the table. So we always have, this is our expected return because of these fair values, but these are the markers that will tell us we got it wrong, get out, or we also got it right, maybe it panned out too soon, take money off the table and reassess.
Okay.
Yeah.
Okay. Thank you. And then I guess moving to, and again, a few questions that I'm putting together in terms of asking you this is, it's really around, as you said, the different levers you have. Where are you seeing the opportunities at the moment? So maybe within which asset classes are you most positive on, and which are you least positive on?
So most positive currently fixed bonds. Okay. If you think, we're saying inflation is behind us. We expect inflation both locally and globally to trend down. Our inflation expected to move closer to the 4.5 target range, with core inflation actually at those levels. So we don't see value in inflation-linked bonds, which is why we sold it down to 0. But we're 60% overweight in nominal bonds, and that's the 3 and 7-year area of the curve, because we expect, as the market increasingly prices in recessions, the expectations that interest rates cuts will come through will support that short end of the curve. And then offshore, we also as I said earlier, we quite constructive on offshore bonds, except we got it wrong in terms of entry levels. So we also looking to go long that space. And pref shares, neither here nor there. There are only two banks now left that need to buy them back. And what's our other property? I mean, we're not expecting it to perform well in a recessionary environment, hence the defensive positioning there.
Okay, so you still don't like property?
If you put it like that.
Okay, and then I think a great question from Ricky, which is clearly he's having a serious consideration on terms of what you said, because he says, most of my clients are in the income fund. Should they switch to flexible? And he does make the point that these are retired investors.
Well, I'll lead by saying I obviously cannot give advice. I'm not, by law, I can't give advice, but I can give a view, which is to say, remember, running yields now are over 300 base or 3% higher. Income fund running yields is at 9%. Yeah. And given that the duration in that portfolio is very low, you can expect for the next year that that's how much you'll get out of the income funds.
The 9% type number.
The 9% type number. That's a traditional income fund where his clients are in now. Now, I don't know the other considerations around. Yes, they are retirees. Do they just need income to tide them over? Do they have shortfalls that they need a bit of capital exposure to make up for? So if you think, so we expect 9% total return out of income funds and around 11.5% for flexible income fund. So if there's a need for additional extra return, then it's worth maybe switching some of that money up higher into the flexible income portfolios.
Okay. Thank you.
Not advice, just
sure.
A view.
No, just a view. Thank you for that view. I hope that answers it, Ricky. And then I'll just go to a few other, these are probably more view type questions. There's a question on, do you think the MPC has another rate increase proposed, or will the US lead this decision? In other words, it's probably linking to, are we simply following the Fed, is my read through of that question.
So I would say yes. Where we are now, there's no reason for the Reserve Bank to hike. If you look at core inflation, talks to the underlying momentum in the economy, whether the economy is heating up or is struggling. So it's below 5% as has been for the past 2 months, and is expected to even trend lower towards 4.5%. So which says that there is no underlying inflation issues in the economy. Most of these issues or inflationary factors come from administered costs like electricity. Food prices are also high, or food inflation is also quite high. But it's expected, given the high base that inflation formed last year, that over the next few months, this headline inflation will also move lower. And then when you look at the electricity situation, growth locally is going to come under a lot of pressure, and which then says, should the Reserve Bank tighten even more? Should they restrict the economy even more? My answer is no. So outside of that, I would think the Reserve Bank is done. They shouldn't hike interest rates again this year. But as you said, so the Fed will lead. I don't think so. If the Fed does another 25 basis points and they're done, then the Reserve Bank is done. But if increasingly the market prices or expects the Fed to do another 50 or more before the terminal point, then that might just push the Reserve Bank to do another 25 basis points. But there's really no need. And I hear the views around they need to protect the currency. There's nothing the Reserve Bank can do to protect the currency at this point. It's mainly driven by global factors and some of the idiosyncratic negative news flow that's coming through. It has nothing to do with whether our interest rates are competitive or not. So in my view, the sub shouldn't be hiking from here on.
Okay, but remains Fed dependent in terms of trajectory.
Yeah.
Okay, thank you. A question on just, I guess, view on green bonds as an investment opportunity, given the different levers that you're prepared to pull.
So remember, green bonds mostly, or what we've seen locally, are mostly floating rate notes. And, we've invested in green or social bonds. So the ESG bonds, for a lack of a better term, over the years. But that market is still in its infancy stage in South Africa, right? So for the main income funds, definitely, it's whenever an issuance in the green space comes through, we do support that. It's a right thing to do. But given that it's in infancy stage and clients are actually not at the point where they're happy to sort of forego some of the returns to do good, right, or to have exposure in that space, we're still not seeing price differentials between normal bonds and green bonds. It's still far away from that. So there's still a way to go. But for this particular portfolio, we wouldn't buy green bonds directly because we don't buy underlying floating rate notes. We'd rather choose to allocate to our income fund or extra income fund, which gives us nimbleness when we need to change the view instead of having to try to sell these illiquid bonds out in the market.
Okay, so you're almost saying as any other opportunity, you look at it on its investment merit. And we know green bonds have obviously come in a bit in terms of spread. So maybe the risk return adjustment is maybe not as compelling at the moment.
No, it is compelling. It's not that different to normal bonds.
Okay.
Bond spreads generally or credit spreads generally have come in over the past few years. So it's in line. But we are active buyers of green bonds.
Okay.
Yeah.
Thank you. And I guess two questions. Are you trying to understand what value having a global partner brings to either your process or how you go about managing this fund?
Sure, for this fund in particular. So if you look at our SAA, offshore guideline is 10% to offshore bonds or offshore, actually, not just bonds. That covers offshore property, offshore bonds, and currency. And that 10% actually covers a wide spectrum of investable assets, right? If you look, it's simple to say fixed bonds in South Africa, it's mainly govies. But when you go offshore, it's EM, core bonds, or, or developed markets economies. And our current construct is not actually meant to be able to make very good bottom-up investment decisions to all these jurisdictions. So the value in having an offshore partner like JP Morgan is because most of them have presence in all these jurisdictions, and they have many analysts looking at these markets. They are better placed to make those calls for us, those bottom-up investment decisions in these jurisdictions for us. So we outsource that. But also the added benefit as well is, in trying to be the best, you have to learn from the best so that we don't make the same mistakes that they made when they were coming up. So our constant engagements with them, asking their views around markets, around other EM, South Africa, and so forth, helps in framing our investment decisions or how we make investment decisions. So it's beneficial on many fronts, but for this particular strategy, as you're asking the question, it's mainly we are not better placed to make those bottom-up offshore allocation decisions, so we outsource it to someone who's better.
And I guess if part of your process prices being close to the ground or close to what's happening in the market, it does help to have someone who's got that presence to be able to help with that in that interrogation.
100%. Yeah.
A question which I guess into next year we'll all start worrying about, which is an election in 2024. Does that mean anything from a risk perspective? I guess the first sign we've seen is from the budget to say it wasn't a populist budget. So suddenly there was nothing in the budget to suggest a change in tact in terms of economically, but any other thoughts that you've got as one starts to think of going into an election year and any implications either for policy or positioning?
I don't think policy shifts much at the high level. We still have basically the same technocrats within Treasury, driving fiscal policy. We still have, I guess, the same president who's addressing so many issues. So I don't think we see a shift. Yes, there could be noises say, like we saw in the ANC policy conference, in shifting more left. But I don't think that's what's going to be what we're going to see going into next year. But we must also be cognizant of the social pressures South Africa or the system is facing, and mainly on the unemployment side. And, with inflation even causing a lot more pain for citizens, you can expect that, the Treasury can't just kick down this can down the road around, the social relief of distress grants. We expect maybe in the medium-term budget policy statement or in the February budget next year, some pronouncements to be made, which is why we think that's an upside spending item that we need to watch closely. Is it material enough to change the fiscal trajectory? No, we don't think so. But the risk will come in if, say, some of the efficiency gains that we've seen in SARS and some of the, I guess, commodity-led corporate revenues that outperformed dissipating. Now, how do you fund that? But we still think there's levers that they can pull to address that. But a year in markets, especially the current market environment, is a long time. But that's certainly one of the risks that we flagged early on and we'll keep close to.
Okay, so to Sean, you're almost saying, expect something on the social side, but not enough to scare the bond market.
Not changing policy leaning left.
Yeah.
No.
Okay, all right. Guess conscious of time and with just under 4 minutes to go, any closing thoughts, comments on your side? And then I guess I'll try and summarize.
No, I'll leave you to summarize.
Your conviction remains, and the party is still in bonds and in the flexible income fund.
100%. Couldn't have said it better.
Okay. I guess as we come to a close and with just some of the summary points highlighted on screen, my intention is not to go through every single one, but I think certainly what I've taken away from the discussion is that I think people are saying in the macro and political environment we're in, you want flexibility, you want to have as many return levers as possible, which is what already points to call it multi-asset type thinking or category. And then you're saying you definitely, all on top of that, feel it's important to be able to nimble and active.
Yep.
And certainly, as someone who looks at it objectively, you've shown the track record around that. And I guess the last point is the so what, as you like to push me on, is really just to say for clients, the so what is capital preservation and competitive returns, so sort of sleep easy at night kind of argument.
100%.
Okay. Thank you all for joining us. Hope that was useful and enjoy your afternoon. Thank you.
Cheers.